Hello, Maverick traders. Welcome out to your FOMC prep video as we prepare for the Fed to make a rate statement tomorrow. Let's talk about where the Fed's at. And it's in a little bit of a difficult spot. Now, they're not expected to change rates in any way, shape, or form. They're in a difficult spot, and let's talk about why. So here's the Fed funds rate, and they're expected to keep rates unchanged at 4.5%. Now, the reason that this is a bit of an issue right now is because the Fed sets rates and then the market is supposed to move off of that. Well, if you compare Fed rates right now to Treasury yields, you'll notice that the 10-year yield and the Fed funds rate are effectively at the same rate, right around that 4.33, 4.25, 4.5, right around that same level. And what's supposed to happen is basically the Fed, as they cut rates, will interest rates within the economy, and the Treasury yield, of course, is U.S. government debt. It takes its cue, and those rates go down, 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 and follow the Fed funds. And then they open up money supply, and the economy grows and so forth because money is more readily available. When they hike rates, well, usually treasuries take their cue and they go up with them. But we've seen a disconnect because Fed funds have been coming down and treasury yields have been going up. And treasury yields, that's US government debt, that's what everything else takes its cue from. Because if I can get 4.5% from the US government with zero risk, right? The government has never defaulted. Why on earth would I take risk for something around that level? Well, I wouldn't, right? I would have to get compensated and paid 7, 8%. I'd have to be paid something more if I'm taking risks because I know that I can go to the US government for 4.25% right here, right now. And so the fact that rates have gone up and kind of moved to the upside, even as the Fed's been cutting, that's a little bit of a worrying sign for them. That kind of speaks to some of the tariff news, some of the other considerations that are in the market. So, all right, so if we look at the Fed funds rate target expectations for June, this is the June meeting. Basically, we went from very low probability of being around 3.754%, but the probability was pretty high that we would be around 4% to 4.25%. In fact, on April 28th, it was at a 60% probability. Well, that has now dropped. In the week that followed that, May 5th, that probability went from 60% down to 40, well, 35% basically. You can see that the expectation for a percentage move went from on May 2nd, it was up there at 35%. It went up to 64%, that we would be in the middle of that range. And then the 4.25 went from a 27% probability up to a probability of 71.7% that we would be at that 4.25 to 4.5%. So, in essence, we have seen a drop in probability. This is what this graph shows, a drop in probability that we would be down closer to 4%, and a big increase in probability that we would remain at that 4.25 to 4.5% range at the June meeting. It's showing that the expectations have shifted and the probabilities have increased that we will be remaining here in this 4.25 to 4.5% range through the June cycle. So the rate cut expectation was higher before, and now it is lower. So we're not on this rate cutting cycle as swiftly, as quickly as we had been before. Now, if we turn to equities and we look at the S&P 500 and some other price action. So if we start with the S&P 500, you're basically at this level of equilibrium, right around the 50-period moving average. Do we go higher? Do we trend higher? Do we trend lower? It's that area where it's just kind of choppy and indecisive, and you wouldn't say that there's a runaway bull market, but you're not really falling either. So where do we go from here? Well, this is kind of an inflection point where you could break in either direction, potentially. You could also just kind of chop around here and really frustrate people as you chop around these moving averages for a little while, which I think is maybe the most probable outcome. You can see the volatility index, the VIX, topped out at 60 and it has come dramatically lower. So the market is simply not moving in the same volatility fashion, and a lot of the fears have subsided about the worst case scenarios, but the risk assets like gold are still flourishing. Look, gold has been on a trend and a half here so far in 2025, and just in the last couple of days, you're seeing a continued spike to the upside. If we turn to treasuries and rates, remember that as bond prices go down, that means yields are going up. So bond values are down. They've been, probably at the lower end of the range here for the past few months. If we look at the 10-year, a little bit of a trend down here in the last few weeks. You can see how it topped out there in that time period we were talking about in early April. And the expectations for rates to be cut has been reduced, and frankly, rates are just staying up. Bond prices are a little weaker. Rates are staying a little higher than a lot of market participants had expected. So tie a ribbon on this. I think the Fed is going to come in and basically voice some of the concerns. They're going to downgrade the economy a bit, I would anticipate. They're going to talk about expectations for future rate cuts being lower probability than they were before, and that it's going to be data dependent and those sorts of things. So a little bit of a, let's call it a pessimistic tone perhaps from the Fed at this meeting would be anticipated. Now, let's talk about currencies and where we trade. So here's a long-term daily chart of the US dollar. And it is basically inverse to gold, where gold has been booming to the upside. The US dollar, this is our dollar basket. This is the dollar against all the other currencies. And you can see the deep decline it's been on. We're coming down to the prior lows, which were made just a couple of weeks ago. So it's kind of been basing in here, but essentially still trending lower. If we come into shorter time periods, like a 4-hour time period, really you're starting to break down right here, right now. So US dollar looks weak, acts weak. The long-term trend is down. It's been basing for a while. I would much rather be short than long US dollar against virtually anything else on the other side of that. We also talked about the euro in the market in the currency recap last night, and the euro has been acting weaker. So if I zoom into this chart, we talked about this level of support as it's breaking, and you can see that we're kind of low basing underneath that breakdown as we speak. So the US dollar still a short, euro still more on the short side. Things that have been working a little bit better had been the CAD, although it's given back some ground here. It just started to pivot back up, which is nice. So I really like the Aussie on the long side against US dollar, euro, those sorts of trades. But US dollar probably weaker is the trend, so we're going to try to continue to stick with relative strength, relative weakness, and the US dollar has been and looks likely to continue to be relatively weak versus most other currencies out there. Hope you've enjoyed this FOMC prep video. We'll see you next time. Goodbye, everyone.